Yes, we can.
Great. Okay, so I just want to take this opportunity to invite Shivaar, Sooklal, Terrence, and Andrew Paskaramoorthy to talk about their research titled DRICORN-K, a dynamic correlation-driven non-parametric algorithm for online portfolio selection. You're welcome to share your screen.
Great. Hi, good morning, everyone. My name is Shivaar Sooklal, and today I'll be presenting my research, which was completed in 2020 as part of my honors research project in completion of my honors degree in computer science. I'll just share my screen right now. Chair, can you please let me know if my screen is sharing?
Yes, we can see your screen.
Great, thank you.
Yeah.
Money makes the world go round, and we continuously try to earn more of it with as little effort as possible. A popular way of making your money work for you is by investing it in the stock market. This usually requires a specialized skill set for reading and timing the market, which is often refined through a wealth of experience, a skill set that even the keen Wall Street analysts would not ordinarily have. But what if you had an automated intelligence system, an algorithm that could do all the detailed analysis, the maths, the projections, and simply provide you with a portfolio telling you how and where you should invest your money for maximum benefit? By the end of this video, you will have received a brief introduction to an algorithm that does exactly that. Good morning, everyone. My name is Shivaar Sooklal from the University of the Witwatersrand, and it's a pleasure to be here today to speak to you about our research paper, DRICORN-K, a dynamic risk correlation-driven non-parametric algorithm for online portfolio selection. So firstly, I'm going to introduce the field in which our research is positioned in, namely online portfolio selection, and motivate the contributions that we have made. We will look at the category of algorithm that our research falls under and describe the developments that led to DRICORN-K. In terms of performance, we will look at the data sets used and experiments that we ran in our empirical analysis. And then we will have a brief discussion and interpretation of results along with a forward look on our research. Online portfolio selection is regarded as a fundamental problem at the intersection of computer science and finance. Online portfolio selection algorithms construct portfolios to maximize an investor's cumulative performance, which is often measured without reference to risk. Now, these algorithms achieve this by specifying procedures to update portfolios sequentially as market information arrives. Online portfolio selection aims to answer the question of how do we design and continually update portfolio as we receive market information in real time in order to obtain the best performance. Now, there are several approaches to online portfolio selection, and these algorithms can be broadly categorized into 4 categories, namely follow the winner, follow the loser, pattern matching, and meta learning. Now, of these 4 categories, we see that pattern matching approaches are based on the most plausible assumptions. Further empirical studies on pattern matching algorithms have shown that they outperform these other approaches. And in particular, the CORN-K algorithm presented by Lee et al. Has provided promising results. But despite CORN-K's successes, there are gaps in its implementation. Firstly, it does not take risk into account during portfolio optimization. And secondly, it doesn't try to take advantage of this risk in varying market conditions. Now, both of these can lead to poor investment returns, especially in volatile markets. Additionally, it can result in inferior risk-adjusted returns by not adjusting for current market conditions. In our paper, we address these issues by extending the CORN-K algorithm to present DRICORN-K. And our specific contributions are discussed discussed in the sections to come. The DRICORN-K algorithm uses the Pearson product moment correlation coefficient to measure the similarity between two given market windows. This enables DRICORN-K to extract information both on the closeness and direction of market windows. And this is done at a market-wide level. Bearing this in mind, how does it all work? So let's consider, given time series data of a market's history, DRICORN-K aims to find the best portfolio, or in other words, a blueprint of how one should invest their capital today. So for a given day, it looks back at the market history and tries to find the set of all market windows in history that are most similar to the current market window. And this similarity is measured by the correlation coefficient mentioned earlier. But how long should a market window be to ensure that the most informative trends are captured? And how similar is similar? So DRICORN-K takes care of this by considering every market window size smaller than some given input size, and considers various correlation coefficients thresholds, which is also given as input. Thus, for every possible market window size and correlation threshold combination, we find the set of all similar market windows. From this set, we look for the optimal portfolio or expert which performs the best. Now we have an expert for each market window correlation threshold combination, but how do we combine them? And that's where the K part of the name comes in DRICORN-K. It creates an ensemble of the top K experts and weights them accordingly. We can see that the expert portfolios are chosen based on performance, but the risk associated with this performance is not considered. And in financial theory, risk is decomposed into systematic and idiosyncratic components. Idiosyncratic risk is risk experienced by a specific company or industry and can be diversified away. However, systematic risk is inherent in the entire market and is undiversifiable. Thus, the risk of a diversified portfolio is almost entirely due to market movements. And this can be exploited by adjusting the portfolio's market sensitivity according to market conditions. And this is where DRICORN-K comes in. We extend the DRICORN-K algorithm to exploit upside risk while hedging downside risk. This is achieved by considering a risk measure, beta, which reflects the sensitivity of a portfolio to the overall market. And by classifying the current market trend, DRICORN-K penalizes high beta portfolios when the market is bearish or decreasing, and rewards high beta portfolios when the market is bullish or increasing. The two key components of DRICORN-K are measuring the market sensitivity associated with the portfolio and then determining the current market condition. So for a specific portfolio B, its beta is calculated using the formula that you can see on screen, where RB and RM are the daily returns on portfolio B and the market portfolio respectively. Now, this beta measure indicates the magnitude and direction in which the portfolio moves relative to the market. We then incorporate this beta measure by extending the objective function in the portfolio optimization step, and its formula can be seen at the bottom of the screen. At the end of this formula, the last term, which is the lambda beta term, this term is added when the market appears bullish and subtracted when the market appears bearish. In order to classify whether the current market is bearish or bullish, we implemented 7 different methods for classifying this current market condition, and we'll have a look at these in the experiments section. We tuned our hyperparameters and identified which market classification method to use using a training data set, which was generated through simulation using linear functions of a regressive model. And we also tested DRICORN-K on 5 real-world stock indices, including the JSE Top 40, the Dow Jones Industrial Average, as well as the Nikkei 225. And these 5 stock indices that you can see on screen were chosen to interrogate the performance of DRICORN-K and the other algorithms under various markets and market conditions. For each data set, we selected a time period in which the index displayed a certain trend or pattern that we wish to explore. To classify the market trend, we implemented 7 different approaches summarized in the table on screen. And these include methods based on pure price changes, as well as current versus lagged moving average analysis. And lastly, moving linear regression analysis on price relative vectors. And through our empirical analysis on our training data set, we found that the approach using moving linear regression with exponential weighting performed the best. And this identified method was used in DRICORN-K going forward. We compared DRICORN-K against 12 different online portfolio selection algorithms, including benchmark algorithms, follow the winner, follow the loser, and pattern matching algorithms as well. To measure the performance of these algorithms, we used cumulative return, annualized Sharpe ratio, and maximum drawdown. Now, these metrics provided insight on the profitability of the algorithms, as well as a return per unit risk value and downside risk evaluation, respectively. On screen, you can see the cumulative return of DRICORN-K, CORN-K, and a benchmark algorithm as well. Regarding the results, we find that DRICORN-K consistently outperformed CORN-K on the datasets. DRICORN-K can be seen in the last row of the table. And although DRICORN-K did not always outperform the other 12 algorithms on the test datasets, we did find that it provided valuable advantages in the form of generalization across various markets that the other algorithms did not. In this paper, we extended the CORN-K algorithm to present DRICORN-K, and these extensions included incorporating beta, a systematic risk measure, into portfolio optimization and classifying the market trend. This allowed us to penalize high-risk portfolios when the market was bearish and reward high-risk portfolios when the market was bullish. These extensions were in response to CORN-K not taking risk into account during portfolio optimization and not trying to exploit this risk in varying market conditions. Empirical experiments on the various data sets lead us to conclude that, bearing in mind the performance measures interpretations, our dynamic systematic risk adjustments to CORN-K can result in improved portfolio performance, while also generalizing across various markets. Future work includes improving the methods used to classify market conditions using time series analysis, and to incorporate other market and stock-related factors into the portfolio optimization stage. These include size premiums, value premiums, and momentum. If you would like to find out more information, please do not hesitate to contact myself, and please feel free to read our research paper. I thank you for listening and wish you happy investing. Thank you.
Thank you so much.